When Wall Street wants to know which companies are in trouble, it doesn't always look at the stock market. It watches the bond market. And history shows it's often right, except when it isn't. Debt investors are often the first to see problems in shaky companies. Long before Enron's share price started to plunge, its debt investors were demanding sharply higher prices for tools that could insure against a bankruptcy. Their fears were realized in what was, at the time, the biggest bankruptcy in U.S. history. And in the summer of 2007, while the stocks of investment banks like Bear Stearns and Lehman Brothers were still near their highs, credit spreads for AAA-rated mortgage bonds began to blow out, the first tremors of the next year's global financial crisis. In 2019, SoftBank invested $2 billion, insisting WeWork was a world-transforming technology company, even as the bond market saw a cash-burning real estate business facing serious risks. Within a few years, the company had filed for Chapter 11 bankruptcy protection. But the bond market's skepticism isn't always correct. Sometimes the stock market's irrational beliefs pay off. In 2000, Amazon's bonds plunged in value amid widespread skepticism that the company could survive, given its negative cash flow and its debt load. Amazon's stock, which had already begun to decline, followed the bond market's cue and plunged too, hitting a low of $6 in 2001. If you had invested $10,000 at that point, you'd have almost $500,000 today. Tesla issued $1.8 billion of high-yield bonds in 2017. By March 2018, its high-yield debt was trading around 87.5 cents on the dollar, a sign of skepticism that the company could repay the money. Since that time, its stock has gone up about 20-fold.